So the first strategy you can use is the simplest one. With this approach, you basically invest in one ETF that includes all the biggest companies in all the countries in the world. When you do that, the percentage you have in each company will be determined by how big it is. So the bigger the company, the bigger percentage you have in it. So in order to do that, you go to the left side below equities and click region, then world. The result looks like this. For that strategy, it would be best to sort them based on size, because otherwise you will get a lot of distortions, which we will talk about later. Since you are looking to create the broadest possible base for your investment here, it is not a good idea to look at sector-specific ETFs like, for example, AI or energy ETFs, even though they still count as all world and hence will appear in your filter. The idea here is to buy the biggest possible amount of stocks with one ETF and call it a day. So now that you have done this, you will have to make a choice. Do you want to invest only in the developed markets or literally the whole world, including emerging markets? For those that are new, developed markets are countries like the European ones, USA, Japan, Canada, etc., which have stable rule of law and older, more established economic systems and stock markets. The emerging markets, on the other hand, are countries that are in a transition and might have higher growth opportunities, but also higher risks at the same time. The higher growth opportunities might be there because of the rapid development that has already happened in the developed markets. However, wars, hyperinflation, dictatorships, and revolutions are more frequent. So when you make your decision about that, it will dictate the ETF you choose. Yes, you will have to make your own choice. If you expected me to tell you exactly in which ETF to invest, then I will disappoint you, because this is both immoral and illegal, and every single YouTuber who does it is breaking the law. First, it's immoral because I don't know your circumstances and I should not be telling you what to do. And second, it's illegal because it will be financial advice which neither I nor anyone on YouTube can give you. Alright, after you make the choice about whether you want to exclude emerging markets or not, you are left with two types of ETFs. The first types are ETFs like these. If you go to the description, you will be able to see exactly what the ETF invests in. Here you can see that it follows an index which tracks 23 developed countries worldwide. Think of an index as the rule-based strategy that the ETF is passively following. This here means that this ETF will only invest in the developed world, and you can confirm that by going to the countries and see the list. On the other hand, you have ETFs like this one, the Vanguard FTSE All World ETF, which invests in both developed and emerging markets worldwide. This will be the widest possible ETF you can buy because it has over 3,600 stocks from all around the world. If a company gets big enough to actually matter, you will have it in this ETF. If you go to the holdings, you will see that, for example, it has the Taiwan Semiconductor Manufacturing Company in it, which is not in the previous ETF. This is because Taiwan is classified as an emerging market. So by investing only in the developed markets, you will have missed the company on which basically the majority of the chip manufacturing depends. Whether that's fine for you and you prefer the lower risk, but less broad spectrum of the developed markets, is your decision to make. This is just a part of my video on how to build an ETF portfolio as a European. To check the full version, click on the video that should have appeared on your screen.